Hey everybody, it's your boy Seth. I'm here with Paul and Mo. Welcome to the show. I'm drinking out of the new Everything Monkey Yeti.
Everything Monkey?
Yes, that's what we call it now. Everything Monkey.
Why is that?
Because it's silly. It's sillier than Everything Money. But meanwhile, it is an Everything Money Yeti, and
these are not for sale, by the way. These are actually gifts. I'm getting them. I got everybody who's in the highest Patreon level, the Paul Super Shorts. I got them all 2 Yetis. One is their bite-sized Yeti, and the other one is their 20-ounce Yeti.
Oh, you did order new Yetis.
Oh, 100%. Yesterday, I go, Don, how much? He goes, okay, sounds good. So I got new Yetis for everybody. I got 2 Yetis for everybody in the upper Paul Super Shorts chat. More on that later.
Today we're going to analyze AT&T. AT&T is an incredible company. We talked about, Paul, this AT&T really propelled our channel many months ago talking about it. Unbeknownst to us, it was going to be a big video. My mother has worked there for like 40 or 50 years, from the Ameritech days, the Ohio Bell, the Southern Bell, and AT&T is this huge dividend.
She just retired from there.
Yeah, she did. AT&T is huge with dividend investors. If you go on the dividend, which you don't, but you go on the dividend Facebook groups, they're always talking about AT&T.
Wait, there are dividend Facebook groups?
There are. In fact, Paul, someone was talking about our channel. Somebody said, I said, where did you hear about it? I said, oh, somebody was sharing your videos on a dividend Facebook group. So,
oh, wow.
There's a lot of avenues we haven't even really explored. But I welcome in Paul Gabriel. Good to see you, as always.
Thank you.
And Trader Mo is here. Mo, how are you? Dr. Momentum with your bid and ask. By the way, Mo, we need to get I need to get clean audio of your bid and ask, because I'm going to add it to our sound effects.
Bid and ask.
But today we're going to look at AT&T. We're going to look at the 8 pillars, look at some of the news articles of why it's been popping lately, why it's been in the news, and why it's been interesting. There's everything from the CFO giving updates. They're selling off DirecTV. I'm reading an article about how they broke laws to maybe beat revenues. Maybe fraud is on the forecast, Paul. Who knows? All this is going in to our show today. But we will, as always, look at the 8 pillar analysis of this company, see its health, its free cash, all of that. So, Paul, talk to us about AT&T, what you know, and we'll cut to Trader Mo as well for insight on him.
Okay, so market cap is 205. So it's a big company, been around for a long time. So last year, trailing 12 months, they have a $5 billion loss. Now, whenever you see this, I immediately go then to the free cash flow. And guys, remember, this is our Everything Money website that you can get if you're a Patreon member. More at that at the end of the video. Just please watch the minute. But as you can tell, $28 billion in free cash flow versus $5 billion in net income. This tells me there was some sort of big markdown, write-off in the last year. It wasn't actually a cash loss. Do you follow what I'm saying, Seth?
Yeah.
So since they have a net income that's negative, there is no PE, so that's an X. And their profit margin is negative because they have no profit. Now, I've kind of teased this into the Patreon. We're probably changing 2 of our 8 pillars. It's actually going to be the first 2, the PE and the profit margin. The reason being is I care much more about free cash flow. It's harder to manipulate the free cash flow than it is net income. And profit margin at the end of the day, when you have a negative for a short-term period of time, it doesn't really matter as much. So I'm not going to reveal what the replacement 2 pillars will be. But even in my own investing, I've been changing, even looking at these 2 items. I go strictly to the cash flow. So this will be exciting stuff. Please watch more videos. Well, one thing, their dividend yield, like you said, is very high, 7.24%.
Okay, wow.
So this means if you buy the company, if you buy the stock and it goes nowhere for 10 years, but they just sustain the dividend, you're going to make 7.24% of your money. Now, they had $28 billion in free cash flow, and they paid almost $15 billion in dividends. That's what you need to look at when you're looking at dividends, guys. Everyone out there assumes a dividend is always being paid. In fact, companies will increase their dividend to attract investors. What you don't realize, though, a lot of the times is they're going to issue more debt in order to pay that dividend just to attract investors in and drive stock prices up. This is part of what I don't like about corporate America and how we look at stocks. So many people look at it from quarter to quarter, and these executives are compensated based on how the stock does as opposed to how well the company does. So, from this standpoint, it's about 50% of their money, of their free cash flow from last year was paid out in dividends, so it seems pretty safe there, especially with such a high number. Does that make sense so far, Seth?
Yeah, profit margin is pillar number 3. We want to look at their profit growth over the past 5 years. I'm sorry, revenue. What am I saying? Revenue. Look at me.
You literally said 3 different things there. Okay.
You're changing them on me already. I never got them memorized the first time, Paul. My child has, my 10-year-old knows what they are. I certainly don't, but go ahead.
So revenue I have as the 164 to 171. It's a check mark there. But I want to keep in mind here, it went 164, 160, 170, 181, 171. But it's still growing pretty consistently, which I'm pretty surprised about, to be honest with you, for a company as big. But you got to remember, I'm pretty confident it's because of acquisitions. A company like AT&T is not growing like this. Well, maybe it is. It's been 5 years and they've grown $8 billion, 5%. Actually, it makes sense. But you got to remember, guys, GDP growth is 3 or 4% a year, nominal, not real GDP, nominal GDP, which is real growth plus inflation. If this company is only growing 1% a year, that's essentially losing market share because they should, because of GDP growing, increasing prices, more population growth, they should be increasing the revenue by at least, you would hope, GDP. But that's neither here nor there, but these are part of the things to think about when you're looking at companies.
Pillar number 4 is profit growth over the past 5 years, Paul, of course. You know
now, this one's an X. It went from $13 billion to a $5 billion loss. Boy, look at these numbers, Seth. 13, 29, 19, 14, -5.
All over the place.
All over the place.
Okay, shares outstanding is pillar number 5. What are they doing with those?
We got an X here, 24.67 to 28.63. X marks the spot there as well.
Yeah, boy,
so again, guys, this is our Everything Money software. It's awesome. I use it. Let's go to the balance sheet. Now, on the balance sheet, guys, we want to look at current assets over current liabilities. Current assets, for those of you who are new to the channel, is basically cash on hand or things that can be converted to cash very quickly. And current liabilities are all the debts that are due in the next year. Okay? So if they don't have enough cash to pay those debts that are due in the next year with the money that's currently available, I kind of have a concern about that. Total current assets, $50 billion. Total current liabilities, $60 billion. So AT&T doesn't have the cash on hand to pay their current debts. Now, that doesn't mean they're going under. A lot of businesses operate this way. You need to figure out if this is consistent in history for this company and for other companies in the sector. Okay? Mm-hmm. Overall, though, I still don't like this in general. I still like the fact that companies would be able to have at least enough cash on hand to pay all of their current bills. But again, it's one of the things about comparing it to other companies.
Pillar number 7 is free cash flow. We want this going up. This is cash from operations minus capital expenditures.
So in the last year, now here's something that the Everything Money application does for you. Free cash flow is cash from operations less your capital expenditures. We have added a line. This line does not exist in a regular free cash flow statement. I just added it here, so you have to do the math. It's so easy now. 17.2 to 28 billion.
Wow.
That's a check mark.
Very nice.
And it's consistently growing. But so if you remember the net income and free cash flow should be pretty equal over long periods of time. It's not here. So one of the questions I'd have for AT&T is, guys, why is your free cash flow so high, but yet your net income is all over the place? So figure that out. There might be a good reason for that. So that's a check mark there. Now for the average. Seth?
Go ahead and read them off.
Total, all of them?
Yeah, the 5, please.
17.24, 15.72, 19.47, 28.9, 28.12.
Wow, look at that.
The average
is 22, Paul.
Okay, now, we always multiply by 20, and that's $440 billion. The reason we multiply by 20 is this is a growing free cash flow number, and even though the company's not growing itself, you don't want to penalize the early years of low free cash flow as it's growing. Now, this 20 factor is our multiple. Basically, we're sitting there saying how much we're willing to pay for every dollar of free cash flow.
I'm surprised you put this at 20, Paul, because this company hasn't done anything in 30 years.
Now, we start with 20 because that's what our analysis talks about, our pillar talks about. But what we want to do is you want to adjust that number based on what you think. The point is, it's currently a $200 billion company with 22 billion, so it's basically 9 times free cash flow. So the current company is $200 billion market cap. The average of the last 5 years of free cash flow was 22, so we get about 9 times free cash flow. Guys, anytime you can buy a company for single-digit free cash flows, you want to look at that further. That's a pretty incredible number. Go ahead.
Well, before you say that, I was going to say, we're going to head over to Dr. Mo, Bid and Ask. Does it ever come across your mind, Paul, this stock over the past 5 years has been upwards of $44, $43, just last year?
The only thing I don't like about this company,
$40.
from what I see so far, is their shares outstanding increasing. If they were taking their extra free cash flow and buying back shares, I would absolutely love it. The problem is, so what you need to do is, as part of your analysis, you need to go in their 10K. You need to talk to investor relations. Are you guys planning on doing some share buybacks with your extra free cash flow? Because that's how you make money on companies that are stagnant. You decrease the shares. Can I explain that further?
Go ahead.
So what we're trying to do here, guys, is here's why buying shares back is important. Right now, the company has $22 billion in free cash flow. Now, how many shares outstanding did it have, Uncle Seth?
Oh, you're asking. I don't even know what day it is.
Okay, so right now they have 7.2 billion shares outstanding. So right now it's roughly $3, right? A little over $3 per share in free cash flow. If they start buying shares back, let's say they take this 22 billion and over the next 10 years, they decrease it by 20%. Let's say they take it to 18 billion shares outstanding. And let's say their free cash flow, I totally screwed up. Start from the beginning. Now let's say, guys, they decide to buy back shares. Let's say they want to buy back 20% of their shares. And let's say their free cash flow stays the same. They never exceed 22 billion. Remember last year they did 28 billion. So you still have 22 billion in free cash flow, right? But now, instead of having 7.2 billion shares, you decrease it by 20%. That's 1.4 billion. You're at 5.8 billion shares. Now, Seth, can you do me a favor?
Yeah, I'm ready.
Divide 22 billion by 5.8 billion.
5.8 is a 3.8 as opposed to 3.
Correct. So now you've taken your free cash flow and increased it by almost 30% per share. And then if you apply the same multiple of 9 times free cash flow, which is kind of low, where are you at? You're at roughly $35 a share, when the stock is currently at 28 or 29. So that's how a company that's not growing can gain a lot of traction and get their stock price higher. And that's assuming a single-digit free cash flow. Let's just assume it even goes to 12. You're now looking at 36 and 9.6, $45 share. If the multiple of free cash flow goes to a reasonable 12. So that's how buying back shares can help a company increase its stock price and help investors, as long as the shares are undervalued. If they're buying back shares of an overpriced company of themselves that it's overpriced, that's a bad thing. But this is a company that's currently selling for 9 times free cash flow. 9 times free cash flow. That's pretty reasonable. That means every share they buy back, they're giving themselves an 11% return on their money in free cash flow. That's a pretty good return on your money as a company that's overflowing with cash. And this is how we look at stocks. This is how you understand that you're buying a business and not just buying a ticker symbol or a baseball card. You're buying a piece of a business. And if you were able to buy a business that was even going to do 22 billion the rest of the time and never grow one bit, that's how you make money in a company that's just going to grow, that's not going to grow at all forever.
I just spoke to one of our patrons who just recently got into investing, Paul. He was doing what we've heard so often is just following all the hype guys on YouTube, not looking at basically any of this. And when you say it so precisely, it's just astonishing to watch you. I'm serious. Just sit here and watch you work. This is incredible because I've never thought about any of this.
And this isn't even a deep dive, guys. We haven't talked about 10Ks. We haven't talked about their future. We haven't talked about anything. What I'm trying to sit there and say is, guys, as part of value investing, part of any investing, your job is to find situations that just make so much sense you can't ignore them. Now, what we tend to react to is when we look at stock price, is we see a stock price going up and up and up, or down and down and down. It affects how we feel about the company. But your job is to take yourself away from what the stock price is doing and look at the business itself. The only thing I don't like about AT&T is their shares are increasing. I don't like that. Because to me, a stagnant company that has tons of free cash flow, yes, they're paying a great dividend, but use that extra cash to either make smart acquisitions, which is very difficult for companies to do, or buy back your shares and reward the investors who've stuck with you for a long period of time. You're rewarding with dividends, now reward them by buying back shares. If they currently have 20, let's say on average 22 billion. Remember last year they did 28 billion, 22 billion, they pay 14 billion in dividends. They're left with $8 billion. Guys, the company is currently $200 billion. They can buy back 4% of their shares every single year. In 10 years, $8 billion, they'd be buying back $80 billion of shares. So they're going to return $80 billion. Now the company, you sit there and say, well, the company's worth $120 billion. No, it'll still be worth the $200 billion or more, but now there's way less shares to buy. At $8 billion a year, Seth, what's $8 billion divided by 30, the current stock price?
266
million.
million. You're right, Paul.
Okay, so guys, $8 billion and $8 billion in extra free cash flow. They can buy back 266 million shares a year. Remember, they only have 7.2 billion shares. So every year they're going to buy back over 3% of their shares. In 10 years, they're going to buy back 2.7 billion shares. It takes them down to 4.5 billion shares. But guess what, guys? They still have 22 billion in free cash flow on 4.5 billion shares. So before, they're making $3 per share in free cash flow. 22 billion in free cash flow divided by 7.2 billion shares. If they stay the same 10 years from now, they're doing 22 billion in free cash flow divided by 4.5 billion shares, which is $5 per share in free cash flow. From 3, for doing nothing extra but taking their free cash flow and rewarding their investors by buying back shares. And if you multiply this by a reasonable 12 times free cash flow, you're at $60 a share. So that's how a stock price goes up when companies buy their shares back. So now you've rewarded your investors by giving them a 7% dividend, and because you take shares away, now the stock is worth $60 a share versus $30 a share. It's doubled in price by doing that. Now, we also had to increase the multiple from 9 to 12, but this is all that happens because eventually it'll grab the market's attention as the profit and cash flow per share starts to increase from 3 to 5. They're going to start going, wait, because everybody in the stock market works based on per share value.
Yeah.
So this is going to keep going up. People are going to say, wait a second, their earnings are going up. Really, it's not their earnings going up. The per share earnings are going up, which drives the stock price. That's how you go from a stagnant company. This is a very common question we get.
Yeah.
How do I make money when they buy back shares? This is how.
Incredible. Let's head over to Trader Mo and Momentum. Mo, what are you hearing in the news about this stock and why is it moving around?
So I wanted to add one thing about smart acquisitions. AT&T is notorious for doing very large acquisitions that, I don't know if they're smart or not, but they've done, just off the top of my head, they've done DirecTV, which was huge. They've done HBO Max or HBO, which is huge. They've done Warner Media, huge. So the big one that's sticking out to me is the DirecTV one. And Paul, I actually have a genuine question for you because I don't know the answer to this.
Yeah.
They agreed to sell 30% of their DirecTV to this TPG. It's a private equity firm.
Yep.
And they're going to get $16.25 billion in cash.
Yep.
Does that change your thoughts on how they can pay off debts now, or
well, now they have 16.2
because they're getting that extra cash?
Now they have 16.25 billion in cash.
Yeah.
They can go do something with it.
Okay.
And that would be part of their investing section of the cash flow statement. So it doesn't affect their free cash flow.
Right.
All it affects is their acquisitions and dispositions on their cash flow.
It's a one-time thing.
But they have 16.25 billion. If they want to buy back shares, they can. By the way, here's why they should buy back shares. If they spend that 16.25 billion, what's their current debt? I mean, interest rates are so low right now. They're probably paying low single digits in interest, but they pay a 7.5% dividend. If they spend 16 billion buying back shares, they now don't have to pay 7.5% dividend on that 16 billion. So now, what's 16 billion times 7.5%? Just do 16,000 times 0.075.
1,200.
$1.2 billion a year they're going to save by buying back those shares. That's also how companies do really well financially. They're going to save $1.2 billion a year in dividends by taking that $16 billion and buying back their shares, because now they don't owe that dividend anymore. And so do you see how buying back shares, especially in a high dividend company, can really increase the cash flow of the company? Because now they're saving 7.5% a year on that money when their borrowing costs are 3 or 4%. This is how it works. This is just normal numbers. If you owned your own business and so you told me, hey, how much are you paying dividends out to your investors? 7.5%. Well, what's your debt? 3%. Well, what else are you doing? Well, I just sold a piece of my company for 16 billion. Well, great. Retire some of your shares. You're going to save 1.2 billion. So not only did you get 16 billion, you're also getting a 7.5% return on that by buying back shares, because it wouldn't make sense to pay down debt. Even though debt is, but if the debt's like 3%, I would much rather have them buy back shares and save that 7.5% dividend yield.
What else are you thinking, Mo?
That's why I asked him, because he gave me an answer that I didn't think of. That's very good. All right, so I'm going to go to Momentum. So the reason that this started about 2 weeks ago. When they were around $27.50. That's when this move started to almost $30 right now. And that reasoning, it started on the news of this DirecTV kind of acquisition, sell-off, what have you. So the first thing I want to look at and say is that we are for sure in this 50% rule area. So it's going to be very difficult for AT&T to break through this 31, 50, 32 area, just because all of this big square that I drew, this is called overhang. Want to know more about that? Go to the Trading 101 series. I talk about the 50% rule. I talk about overhang, and that's in the YouTube Everything Money playlist channel. So let me zoom in here of what we can do with it right now, because we have a beautiful uptrend coming through the sweet spot. All I would want to see to exit or enter this position is to get a little bit of a green engulfing candlestick like that. Take out yesterday's high, which was Monday. That's all you need to do to get into this stock. And you have a bid and ask of 1 cent, which is absolutely perfect. So this is a great stock for you to get into long term. Just be careful when you get up to that 32, 33 area. You will have a lot of resistance from the overhang.
We can hardly...
Bid and ask.
We can hardly hold it in.
There?
If you followed the channel for a while, this new phrase from Mo, bid and ask, is just really wrecking us in terms of comedic value. So, Paul, your final take on AT&T? Are you?
I love
these numbers are all over the place. So.
I do like the numbers. I just wish they would buy back shares. The second they make a long-term commitment to buying back shares, I would be a very big advocate of this company. The dividend is very attractive. Don't get me wrong, but they have to grow through acquisitions, and even with the acquisitions, the revenue growth isn't a ton. Don't be worried about the PE. Do not be worried about a negative PE, please. It was a one-time. We had to also figure out what that one-time charge was. But I'm a big fan of AT&T stock if we can just get the buybacks happening.
In terms of price target, I mean, are we already at it, or you just need some things to happen, but regardless of price target?
Yeah, I think I don't know what the price target would be. I don't think it's unreasonable based on their free cash flow to have a price target of. I do think it's undervalued. If they just keep their shares the same, it's undervalued. I think you're just going to get a good steady stream of income. You're going to be able to make double-digit returns, including your dividends. Forget what that means, but you're going to get a good dividend. It's going to be wonderful. I just always get. And by the way, the number of shares outstanding isn't up a ton. It's about 50. Well, it actually is up a ton, about 2 or 3% a year. I want that stopped or going down, and I will be a big fan of AT&T because of. I don't care how big and slow and monstrous they are. I look at it going, that's stability right there, and you saw that from the free cash flow.
If you like what you're seeing, you can join our Patreon. Click the link below. Our Patreon is growing just incredibly. We started it a little over four months ago, and over. 1,400 people are in it. You get your own Discord channel. Let me just say this. People are drawn to this idea, Paul, when I say, like, if you're getting... I keep hearing stories from our patrons about how they started, and they say, I was listening to those hype stocks, these guys in their spare bedroom giving you financial advice that they think is sound. And spoiler alert, we told Paul this topic... the show's been going for about 24 minutes. We told him 27 minutes ago we were talking about AT&T. This guy can come up with all the stuff off the top of his head about the health of a company. It's incredible to sit here, Paul, as a fan, to watch you do all this.
Thank you so much.
And so if you're drawn to this and you need to speak to someone in this world instead of feeling alone in your journey of investing, you can join our Patreon. The levels are filling up so fast. The bottom level fills up within a week, Paul. I mean, it just...
Yeah, it's incredible. We think our Patreon right now is on pace to double in March. From March 1st to the end of March, it's on pace to double. And listen, the sooner you get in, the lower your price is. You're locked into that price, except for, you're locked in that price basically forever in that price category. It's wonderful. You get the software, and the software will be getting better and better.
Paul's going to pull up a chart real quick. Well, Mo, tell people what you're doing in your Mo's Muscles tier in the middle. We'll tell you doing it for day traders. If you're drawn to day trading, you can listen to Mo. Go ahead, Mo.
So we do. And if you guys want to day trade, we can day trade your hearts out. But I also do a lot of swing trades, which is day trading. And then something that I really want to push more is that I do a lot of long-term trading. So this is weeks to months of trading. So if you have a full-time job, you don't have time to sit at the computer all day, you don't have time to talk to me all day, that's perfectly fine. Stop in every once in a while. We'll find something like AT&T where you can jump in and ride this thing for a couple of weeks or a couple of months, depending on the chart, and make money that way. So you don't need to be sitting on the computer all the time to be chart trading. But if you want to, we got day trading for you.
Speaking of charts, I made this last week. The price has already changed. It used to say 14, now it's 15. It goes up every week. This is what you get with our 8 Pillars website, or you will get in the future. These are all the things that are made or will be made. 8 Pillars, 10 years of financials, stock value calculator. It'll tell you based on your assumptions what to pay for a stock. Here are our biggest competitors. This is their monthly fees, guys, to entry level. And you don't even get everything. This is a no-brainer. This is the best value play you'll have. This thing is going to $49 and $100 a month at some point in the future. But if you get in at 15, you're stuck there. You'll be there. Even if it goes to $50, all you'll have is yearly increases that are small, 50 cents or $1 a year, because we're going to have cost increase. I had one developer 2 days ago. I called you last night and said I'm hiring 2 more developers.
Yep.
Why? Because this is what's gonna be the focus of this channel, is the software, because of how valuable it is. And the best part is, I was making the software for Mo and I. So you were getting exactly what Mo and I were gonna use for our own business, our own investing. So anyways, you get the Discord, you get everything, join up.
Yeah, if you also join our Patreon, you'll be automatically entered in our Tesla giveaway. This is a big week. The Tesla promo video that we shot is coming out. We're giving away 2 brand new Tesla Model 3s this year when we hit 50,000 subscribers and 100,000. And so join along with the ride. You have a chance to drive away with one of those Teslas. That is our take on AT&T. As always, on your way out, make sure you tickle that thumbs up and subscribe. We love you guys, our dear patrons. You know we adore you. And we'll see you at the next video, guys. Thanks so much. Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.